Alright, today is Sunday, February 7th. This is a post market review for the stock market activities on Friday and an outlook for this upcoming week. The market's dynamics last week was as the following. On Monday, Tuesday, and Wednesday, we saw buying of the Nasdaq. All of the outflow that took place in the prior week to raise cash to cover for all of the short positions in GameStop, AMC, and the likes, all of a sudden had to be returned and be deployed back in the Nasdaq because all of these stocks started to decline lower and lower and lower. We're talking about GameStop, AMC. The collusion with the brokers allowed hedge funds who happen to be shorting these stocks to cover at much lower prices, and all of a sudden they don't need to raise cash by selling their Nasdaq positions. By Wednesday, we were already trading at all-time highs almost in the Nasdaq, and we started to see signs of exhaustion in the inflow toward the Qs. So I predicted that the next rotation will be toward the IWM, specifically the reopening names. And you saw that exactly happening on Thursday and Friday, and the Russell 2000 managed to trade all the way to all-time highs. So the question is, where do we go from here? What will they pump next week? The laggard for this week was the SMH or semiconductor stocks. You have to remember that chips trade as a canary in a coal mine for the entire Nasdaq. They are a leading indicator to where the Nasdaq will be trading next. And we saw this pattern, the synchronization between the movement in the SMH and the Qs going all the way back to the March bottom in 2020. Last week, however, we saw the first divergence between the movement of these two indices. The Qs went higher while the SMH went lower. So the question is, will we see the inflow chasing the dip in the SMH next week? Or are chips trying to tell us something here, that the market has a massive crack and we are not paying attention? The other thing that we witnessed on Friday was the fact that Robinhood allowed trading in GameStop and all of the other stocks that they were banning. They have raised a lot of cash, and these stocks dropped way lower from where they were trading last week. And of course, now they're allowing trading in these names. What happens when you allow trading in GameStop, for example? The stock goes higher, and we see shorts covering once again, but they are covering at much lower prices. Furthermore, the interest from the retail side has diminished significantly. They know that this was a pump and dump. They saw the pump, and now we are in the dump phase. That doesn't mean that the squeeze cannot continue throughout next week. That would be a trap for the next batch of sheep to march toward the slaughter once again. So if we see a continuation in the squeeze for GameStop, AMC, etc., that would be an opportunity to get out, reduce your losses, or perhaps eke some profits and get the hell out of that trade once and for all. And here is what happened on Friday. The sheep portfolio, the Wall Street Bets/Reddit portfolio, suffered some losses all in all, but we saw an outperformance from GameStop and costs. Of course, trading was allowed on Friday, and we saw some short covering in these names. Yet we did not see a sell-off in the suits portfolio, the hedge funds portfolio. Things were muted, yet we saw some gains in names like Google and Facebook. But the moral of the story, of course, is that those rebels without a cause from Reddit suffered massive losses this week. We are talking to the tune of 80% or so in GameStop stock in a single week. Of course, this will serve as a warning and disciplinary action to a lot of retail traders that what happened in GameStop stock could happen in the broader market as well. Some will listen, but most will ignore and will continue to chase the hot trades and engage in massive risk taking. That is just the nature of the beast. And in this video, we will discuss all of that and more. We have extra coverage in this video in the options market regarding what happened on Friday for Tesla options. We saw a significant increase in volume and the premiums surged higher, specifically late on Friday. But the surge in prices happened in puts, not calls. So the question is, do we have pending news regarding Tesla next week and beyond. And of course, we will talk about the jobs report during the headlines of the day segment. We have updates on all of the mania, the sentiment indicators, and how this particular mania has emerged into extreme levels, to comical levels, and I will show you examples from the investment geniuses over at TikTok. And then, of course, we will discuss the whole war against shorts led by scam artists such as Shamath and the likes, and an update to what's going on with Clover Health. And stick around for the conclusion of the video because we will discuss an update to the strategy that I started last week. With that being said, let's go on and cover the market. And here we go. The Dow Industrial Average closed in the green by 92.38 points, or a gain of 0.30%. The Nasdaq closing in the green by 78.55 points, or a gain of 0.57%. The S&P 500 also managing to close in the green on Friday by 15.9 points, or a gain of 0.39%. And what about the sector's performance on Friday? Here it is. We saw a decline in the US dollar, a big one, the first decline in days. And right away that helps what? Materials, energy, industrials, etc. And we saw basic materials coming up at number 1 and capturing the gold medal. And at number 2 for the silver, communication services. Number 3 for the bronze, consumer cyclicals. The laggards of the day led by real estate, technology, and financials, even though every single sector managed to close in the green. Let's contrast that with the performances for the entire week. Leading the pack and capturing the gold medal, communication services at number 2 for the silver financials. And we saw a continuation of the rise in the 10-year Treasury yield. And number 3 for the bronze, consumer cyclicals. The laggards of the week, if you can call them that, led by healthcare, utilities, and consumer defensives. Every single sector managed to close in the green for the week, and we are talking about massive gains. Every single sector of the market managed to close above 2% gains. And the question is, are we heading to a last hurrah type of rally like we saw back in August 2020, the last part of August, an impulsive blow-off top kind of rally? We will discuss that and a lot more during the charts analysis. For now, we're moving on to the futures market. Here is what happened on Friday. A decline in the US dollar that is good for pretty much the majority of futures. We saw gains in crude oil, both the WTI and Brent. But what about softs? Massive gains for coca, OJ, coffee, lumber, sugar. The only laggard during Friday was cotton. But remember, cotton scored massive gains for the week overall. We do have a position in OJ, and the exit point here, we're looking for 115 to 116. We're playing a rebound. The trade is profitable for now. What about metals? Massive gains. Gold, silver, platinum, copper, palladium, all of them closing in the green. Gold is the laggard here. And of course, we have a technical bearish signal for gold, the so-called death cross, when you have a shorter dated moving average crossing below the longer dated average. In the grand scheme of things, that means absolutely nothing, and I pay no attention to it whatsoever. However, the algos react to the death cross, and you saw massive declines for gold on Thursday. Usually, once you do the death cross, you're not going to decline for one day and then rebound higher, and that's that. Usually the drop is followed by a few days of declines before you find a bottom. But we know what will dictate the direction of metals from here: the US dollar. And the US dollar is being very, very sensitive to the news we're hearing regarding the stimulus, how large the stimulus will be. The larger the stimulus, the more money supply, the more pressure would be added on the currency. And what about meats? Muted activities for live cattle, feeder cattle in the red. Meanwhile, the gains in lean hogs go on and on and on. What about grains? The weakness continues in grain. We saw declines for soybean futures, corn, rough rice, oats, canola. The only futures managing to close in the green on Friday, wheat futures. However, keep in mind the grains futures scored significant gains throughout the week. They have been on a tear since last year. So all of what they're doing right now is taking a break and looking forward to revitalizing the rally. Moving on to the big casino, the options market, and let's see what happened on Friday. Coming up at number 1, per usual, the hottest table in the casino, Apple, with about 1.6 million contracts traded for the day. About 69% of those were calls. And here it is, number 2, rising from the dead, Tesla, with about 1.2 million contracts trading on Friday. About 58% of those were calls. I've been telling you, Tesla has been dormant. The stock has been flat, doing absolutely nothing because this stock solely moves based on the options activities. Throughout the week, we saw volumes around 500,000 options trading each day. On Friday, that volume doubled to over 1 million contracts. And right away, you saw the premiums starting to pick up in value, and the reason is the implied volatility surged higher for all options in Tesla, but specifically for put options. Let me show you an example, and this is from Robinhood. Take a look at the 600 puts expiration date February 12th. The stock risen higher, closed in the green on Friday, just slightly, but the 600 puts exploded higher in value by the tune of 300% almost. Likewise, the 600 puts expiration date February 19th also doubled in value. Meanwhile, let's check out on the calls. The calls expiring February 12th actually declined in value. So what's going on here? Something is brewing in Tesla. We know that the big short, Dr. Michael Burry, has a big position against Tesla. He's shorting Tesla, and he's been dropping riddles and hints regarding the options activities for Tesla. So is he seeing something that we are not seeing? Is there any pending news regarding Tesla that leaked to certain entities? Is the SEC bringing a case against Elon Musk next week? Is there a bomb that is about to drop regarding Tesla next week? We don't know. But you have to keep in mind that even though the implied volatility surged higher for puts, that doesn't necessarily mean the stock will collapse. It could be that the stock is going to skyrocket higher. A lot of people are buying puts or bought puts on Friday to protect their shares regarding any pending news if the pending news happen to be negative. For example, we could hear next week that Elon Musk is announcing another split for Tesla stock, and that will lead the stock higher. We know that Elon has been engaging in a lot of manipulation as of late, but it would not be out of the norm if he announces another split or tries to manipulate the stock price higher one way or the other. For now, all we know is that there is massive volatility that's about to happen in Tesla stock. It's about to rise from the dead, either to become alive again or to rise as a zombie. And while we're at it, let's discuss a trade I placed against Tesla a few weeks ago. And this was an earnings play. The whole point of this particular trade was to take advantage of the elevated premiums back then. And the trade, in simple terms, was to buy the 600 puts, expiration date February 19th, and that would cost you about $12 a piece. But to take advantage of the elevated premiums, I decided to construct the trade on 3 legs. One leg is to buy the 600 puts, expiration date February 19th, but the other leg is a calendar spread. By selling the 600 puts, expiration date January 29th, that was the week where Tesla was supposed to report earnings. And by selling that one, I collected about $5 a piece or so. At the same time, I sold the 500 puts expiration date February 19th, and thus using a calendar debit spread hybrid. And for selling that leg, I collected $5.50 a piece. All in all, reducing my entry price for the trade to $1.50. The 600 puts expiration date January 29th expired worthless as I was expected, meaning that the $5 that I collected from that particular trade is now in my pocket, guaranteed. And I told you guys, if your broker does not allow you to construct the trade on 3 legs right away due to the collateral requirement, here's what you have to do. Open the calendar spread first, and when the leg that you're selling expires worthless, open the other leg by selling the 500 puts expiring February 19th. And remember, the success of any options trade is dependent on the following. 50% of the success of any options trade is dependent on the construction. 25% is dependent on the management of the trade after the fact, and then 25% dependent on luck. So if you miss the construction part, you missed on 50% of what determines the success of any options trade. And in this case, we do have a trader who unfortunately followed this trade by only opening the 600 puts expiring February 19th, paying about $12 a piece or so. Right away, the whole purpose of constructing the trade went out of the window because he overpaid for that particular option. The premiums were elevated pre-earnings, so the damage has been done now that Tesla has been dormant and not moving to the downside or the upside, and the trader has lost significant amount of money on this particular trade. So the question is, how do we repair that particular trade, or at least attempt to repair it and reduce some of the losses? Before we do that, let's review the Greeks determining options prices. Delta is pretty much determines how much your option is going to change in value depending on the movement of the underlying stock. For example, if Tesla moves higher by $1 or down by $1, how would that impact the price of your options? That is delta. Gamma, on the other hand, represents the rate of change in delta. When we talk about a gamma squeeze, now you know what we're talking about. Gamma changes based on the demand for options. Now we have theta. Theta is how time will determine the decay of those options. And then you have vega. Vega determines how will the price of your options change depending on the volatility of the underlying stock. And then you have rho. That's not important because it is tied to the change of interest rates, and we don't have any change in interest rates right now. So back to my trade. I don't have delta on my side because the stock is trading at about $800 or so. Meanwhile, my strikes at 600. So the stock's trading way above my strikes, even though the trade is profitable for now. And the reason is gamma started to rise higher when we saw the demand for these put options surging on Friday. Likewise, if the implied volatility on the stock is surging higher, Vega will serve option premiums higher. The only thing going against me for this trade is theta. I only have 2 weeks for Tesla to drop 20% plus for these options to be in the money. The likelihood is we're not going to wait till expiration to close this trade. As soon as Tesla drops and you see Vega rising higher significantly, gamma, delta, you know that theta is going to be against you either way. But the trade is going to be really, really profitable to the tune of 400, 500, even 1,000%, depending on how big Tesla is going to drop. Assuming it's going to drop, of course. It's not going to surge higher due to another stock split, etc. But in the case of this trader who did not follow the construction for whatever reason and just opened the naked puts, let's see how the Greeks are working for him or against him. Delta's not working for him. Theta's not working for him. Gamma's certainly not working for him. Vega was not working for him. But now that the implied volatility of Tesla surged higher, perhaps Vega is going to start to work for this trader. So how do you take advantage of what's going on here if you are stuck in the hole in the case of this particular trader? My suggestion was sell the 550 puts. For example, let's say that you have two 600 puts, expiration date February 19th. You can sell 2 puts for the strike price of 550 for the same expiration date, and you can raise some cash. You use that cash to reduce your entry price in the 600 puts by buying more. And now your ratio is going to be, for instance, you have 3 of the 600 puts that you bought versus 2 of the 550 puts that you sold. And let's say that you managed to reduce your average entry cost from about $12 a piece to $10 a piece. Now your profit potential is limited to about $40 a piece. But for that to happen, Tesla needs to drop significantly. We're talking more than 25%, which is probably not going to happen in a couple of weeks unless we have significant news. So what we're doing here is trying to repair the trade, lessen the damage, and perhaps, if we're lucky, turning this trade into a profitable one. Here's what's going to happen. Let's say that Tesla drops 10% or so next week for whatever news. Both the 600 puts the trader bought and the 550 that he sold will appreciate in value. If the thesis against Tesla remains intact, that would be an opportunity for the trader to roll forward. What does that mean? It will mean that the trader is going to open the 550 puts, a position in the 550 puts expiring, let's say, March 19th, and then close his 600 puts from February 19th at a loss. It doesn't matter because right now you're rolling forward and rolling down, which is good in put options lingo, and you're hoping that Tesla is going to decline further and further by the expiration date of March 19th. So again, it's a long shot. It's attempting to repair the damage, but the moral of the story here is 50% of what determines the success of any options trade is determined by the construction of the trade to begin with. I don't want to spend a lot of time here because a lot of you are not options traders. But if you are thinking about starting options trading, this is a very good example, and perhaps we will discuss this case in details later on in a separate options course. But for now, we're back to the coverage again. And on Friday, we saw that AMC once again coming up at number 3 with a little over 850,000 contracts, about 60% of those were calls. Let's check on and see if we have any unusual activities in the options market during Friday, and we have plenty of them. Here's the trade for Tesla. Somebody bought the 800 puts expiring April 16th with expectation that the name will decline over 6% by then, and they paid big bucks for it. They paid about $72 a piece to enter this trade, and that brings the total to about $14.5 million. So somebody's bidding big bucks against Tesla here. But we also saw significant activities in call buying, so it is not tilted one way or the other. All we know for now that there is something pending for Tesla. And what about this trade for Etsy? Somebody bought the 210 puts expiration date March 19th with expectation that the name is going to decline over 9% by then, and they paid about $11 a piece to enter this trade. That brought the total all the way to about $6 million. Big trade right there. And here's the other one I want you to pay attention to. For the ticker ZM, this is for Zoom. Somebody bought the 450 calls expiring February 12th, meaning this upcoming week, with expectation that the name is going to rally over 7% by then, and they paid about $5.80 a piece to enter this trade, and that brings the total all the way to about $6 million. So pay attention to this one. Why is the trader buying this much worth of Zoom calls? Perhaps they're just playing a technical bounce. We will see if there is pending news or if it is just based on the technicals. Continuing with interesting trades, here's one for the ticker MGM. This is for MGM Resorts, and we know that the name is going to report earnings this upcoming week, so this is an earnings play. Somebody's buying the 36 calls expiration date April 16th with expectation that the name is going to rally over 5% by then, and they are paying about $2.50 a piece to enter this trade, and that brings the total to about $1.7 million. And here's the last trade we're talking about today for Amgen, the ticker AMGN at the bottom of the table. Somebody's buying the 250 calls expiration date March 19th, the expectation that the name is going to rally over 6% by then, and they are paying about $2.75 a piece to enter this trade. That brings the total all the way to almost $2 million. Moving on to the headlines that shape the day, and starting with the big jobs report. And right away, we've created about 49,000 jobs, and the unemployment rate dipped to 6.3%. Now, this jobs report was abysmal. It was a negative jobs report because the pace of job creation has slowed down significantly. And the majority of the jobs we've created were in the government sector. Meanwhile, we've lost jobs in education, leisure and hospitality, manufacturing, and other sectors. But here is the take. This is a tweet I issued right after the jobs report. The November and December jobs data were revised down. The November number went down to 264,000 jobs instead of the number they told us back then, 336,000. 1,000. And in December, we've actually lost 227,000 jobs instead of the loss of 140,000 jobs that they told us back then. Tell me again that the books are not being cooked. They release the fake jobs report number to accommodate whatever purpose they have to prop up the market higher, and then they revise these numbers down when nobody is paying attention. So always assume that the number they're going to release for the jobs report is being exaggerated, and assume that it is much lower than the numbers they're releasing. And here it is, by the way, we cannot celebrate any creation of jobs when we have the labor force participation ticking down to 61.4%. The labor force participation has not recovered to the pre-pandemic levels, and it's been declining and declining and declining for years and years. People have given up on looking for jobs. And here is the other bad news. Permanent unemployment ticked higher in January, and you see that illustrated for you in the blue line on the chart. So the picture of employment remains abysmal. And tell me again how the Fed is helping with their quote-unquote employment mandate, ushering the tsunami of liquidity to create asset bubbles both in real estate and the stock market, making the rich richer and widening the wealth gap. Meanwhile, the tsunami of liquidity did absolutely nothing to help in the unemployment picture in America. If you bought the Kool-Aid, the Federal Reserve works to help the employment picture. This is the proof for you that that is not the real mandate. The real mandate for the Federal Reserve is to prop up and inflate the assets of the wealthy. And by the way, right after we saw the jobs report being released, we saw a lot of volatility in the 10-year Treasury yield. Remember, the biggest threat right now against the stock market is the rise of the 10-year Treasury yield due to inflation. This jobs number, assuming that it is cooked of course, and the real numbers are a lot lower than what they're giving us, was abysmal, meaning it should have added downward pressure on the 10-year Treasury yield. And we saw that happens initially, but yields managed to bounce higher right away. This is the scary part, and nobody's paying attention, by the way. When the market blows up due to a sudden surge in the 10-year Treasury yield, don't say that you were not told. Why did we see the decline in the beginning and then yields picked up higher anyways? The reason is, yes, the unemployment picture is not good right now, but inflation is rising anyways due to the rise of commodities prices and the money supply. Furthermore, the more we hear about how big the next round of stimulus is going to be, and the pressure, the inflationary pressure from increasing minimum wages, all of that will be a force to push yields higher and higher, regardless of how bad the employment picture is right now, meaning that the trajectory for the 10-year Treasury yield is higher and higher and higher. And as the risk-free rate rises higher, stock market valuations have to be cut. And here is your update on the stimulus. Representative Jim Clyburn says your $1,400 stimulus checks coming within a week of approval. So once they approve the stimulus checks, they will be out there in a week, and they will go where? The stock market, the call options gambling, you know the deal. And perhaps that would be the nail in the coffin for the stock market, because that would pierce and pop the bubble right away. However, there is some good news for the bulls, because here it is. Biden is now bargaining that, he might settle to an $11 minimum wage instead of the $15, meaning that Biden is throwing these large numbers, $2 trillion stimulus, but in fact, he would settle down to say 1.2, 1.3, still a very large stimulus, however, much less than what the market is pricing right now. From history, we know that Joe Biden likes to talk the talk, but at the end of the day, he does not walk the walk, and he compromises for much less than what he was asking for. Before we move on to sentiment news, let's discuss the corporate specific news we have for this video. And it is for Ford. Here it is. And this is for people who are confused why I sold my GM shares and decided to rotate to Ford instead. Here it is. Ford has this billion-dollar advantage over Tesla's and General Motors electric cars. Ford cars still qualify for key federal credit. Here it is. Every electric vehicle in the US, including plug-in hybrids, entitles the buyer to a federal tax credit worth up to $7,500, depending on how big its battery is. But once a company reaches 200,000 units sold, the credit phases out by half, and half again before going away completely over the course of a year. Since Tesla and GM been producing electric vehicles for a while now, they've already exhausted that federal credit advantage. Ford, on the other hand, still has plenty to offer in terms of federal credits, and their cars will be more competitive in the market against Tesla and General Motors. Now, moving on to sentiment news, and here it is. The S&P 500 price to sales ratio just notched a new record high. But hey, listen to Tesla witch Kathy Woods. She says we're not in a bubble. I ask you gently and kindly to pull your head out of your ass. You can still keep your rig in there, but just pull your head slightly so you can see the light. And take a look at this chart and tell me again that we are not in a bubble, that this market is not dangerous, and we still have a lot to go before the bubble ends. Of course, your buddy Jerome Powell says pay no attention to the PE ratios because the risk-free rate remains low. Well, since he issued the statement, we're back at almost 1.2% in the 10-year Treasury yield. If we continue to rise higher on the same pace, we could reach 1.5% by the summer. That would be a death sentence to a market this overpriced. Now, what about the penny stock mania? Continues to go on, and we managed to spend over $70 billion last year alone in penny stocks. What about the margin borrowing mania? It continues to go on. Margin debt to GDP ratio is at all-time highs. Is this a recipe for disaster or what? When everybody's gambling on borrowed money, what will happen if things go wrong? I'd like you to think about that. Moving on to the junk bond mania. What's going on? It continues to go on and on every single day. Another day, another record low for U.S. junk bond yields. They're now just 4.9%, roughly one-third what they were less than a year ago in March. So we have the penny stock mania rages higher. The margin borrowing mania continues to go on. The junk bond mania getting hotter and hotter and hotter. What's next? Here's next. The SPAC and call options mania. Day trading SPACs, buying $44 billion worth of call options. Is this a recipe for disaster or what? And by the way, here is from professional pumper Mark Cuban, who was standing with the GameStop holy war against the hedge funds, which we now know that the hedge funds of Wall Street ended up being the biggest winner, and retail traders got slaughtered. Of course, Cuban kept on egging retail traders to continue to march in their useless, purposeless war against quote-unquote hedge funds and encouraged them to hold the bag. Here is Mark Cuban. Where do you get most of your stock trading or investing information? If it is not listed, please post it in a reply. Number 1, Twitter. Number 2, Reddit. Number 3, YouTube. And number 4, TikTok. This is the most informed generation, according to Chamath, Mark Cuban, and Elon Musk. And speaking of Elon, here's just a reminder that these are not traders, they're not investors. This new generation of quote-unquote investors are actually a bunch of zombies high on meth looking for the next score. They don't care what the underlying company is. Just feed them a ticker, give them a ticker, and they are ready to swarm. Here is an example. Elon Musk tweeted, "Sandstorm is a masterpiece," and he was referring to a different thing. Although Elon Musk has been manipulating the market as of late, dropping hints and riddles, and moving whatever underlying stock or cryptocurrency he wants to move higher. Right away after the tweet, here is a company called Sandstorm Gold. And the stock of that company surged significantly higher, almost doubling right after Elon Musk's tweet. If Elon Musk tweets, "dog shit is good," these morons will stampede to death to buy dog shit futures. And what about the ARK Mania? What's going on with Tesla witch Cathie Woods? We covered her in the previous video, but here is more. Now people are starting to pay attention to Tesla witch Cathie Woods' fraud. It is Cathie Woods' word. The rest of us just live in it. ARK has taken in more money year to date with just 5 funds than BlackRock, State Street, and they're only trailing Vanguard. Cathie Wood amasses 50 billion and a new nickname, Money Tree. So Tesla witch Cathie Woods, of course she's a very good saleswoman. She managed to deceive all of these zombie retail traders and investors who joined the market since the March bottom into dumping whatever cash they have in her ETFs. Now we know that Cathie Wood's style of investing worked tremendously in the 2010s, but that is coming to an end as we enter a new era of inflation, meaning value stocks will outperform the overpriced garbage that Tesla witch Cathie Woods packaged for you in her ETFs. But of course she's not going to tell you the truth because she continues to collect billions and billions of dollars worth of fees from your quote-unquote investment. And here is from the Wall Street Journal. Cathie Wood has Wall Street's hottest hand, maybe too hot. ARK Investments' money under management grew more than 5-fold from March to the end of last year. But when funds get too big too fast, they often cannot sustain their performance, specifically if that growth was based on Hui. And of course, they keep telling us that this is the most educated generation, the most aware generation. And we're not talking, by the way, about Gen Z or millennials or X or boomers, etc. We're talking about the zombie generation of investors who invaded the market during the pandemic. They have no clue what they're doing, and they cannot do a simple Google search to see what happened in the past. Here is from The Big Short, Michael Burry. Shades of Gary Pilgrim and PBHG growth from the 1990s, or Gerald Tsai and the Manhattan Fund in the 1960s. ARK Invest is defining an era. Pay attention now. If you know your history, there is a pattern here that can help you. If you don't, you are doomed to repeat it. Michael, this new zombie generation of investors is doomed to be slaughtered. They cannot learn from history. They're zombies high on meth looking for the next quick score. They're not interested in investing whatsoever. And if you know your history, you know that Gerald Tsai managed to walk away very, very wealthy from his bubble fund. His investors, on the other hand, lost 60% in one shot. It was so brutal. 60% one shot when the whole bubble blew up. And we realized that this hyper-growth type of investing is not sustainable. Don't expect the new donkey generation of investors to understand that. They're only going to learn the hard way. And bears, of course, are licking their chops. They're waiting and waiting because they know that once the whole ARK Mania pops, that would be the shorting opportunity of a lifetime. And bears are going to eat the flesh, the bones, and the skin of ARK Invest. The amount of inflows are perhaps the biggest risk for a fund that had a small fraction of what it has now. Days to liquidate some of the illiquid positions risk will force selling in the larger, more liquid positions. Are you paying attention or not? Here's more. Cathie Wood's ARK is running the same 1999 high octane, valuations beat down model as Alberto Villar's technology fund. Of course, most of you don't even remember or know what the Amarendo technology fund was. But this is your opportunity to do a simple Google search. In addition to Jacob Internet Fund, Kevin Lance's First-Hand Technology Value Fund, they all got smoked when the trend reversed. Ignore history at your own peril. And here it is. The bears are getting very, very emboldened. They're looking at a delicious meal that's about to happen. Wall Street Journal article says ARK has almost 50% of the fund in stocks where they own 10% or more of the company. Cathie Woods, I look forward to feasting on your carcass when flows turn negative. Gonna be easy to get some predatory shorts going in all your small caps. Again, it's gonna be the biggest meal the bears will feast on for years. And that leads us to the extreme mania that flooded the market these days. We have reached, ladies and gentlemen, hysterical levels of the mania. Here is somebody getting a tattoo reading Diamond Hands. And this is not going to age very well, by the way, not due to the aging process where your arm is going to wrinkle. It's not going to age very good due to the fate of this market. And by the way, here is this lady. Her name is Mia Khalifa. I'm not familiar with who she is really. So I did a simple Google search about her, and it says that she's a photographer. I visited her Twitter page and she has over 3.5 million followers. She must be a very talented photographer. Oh, wait a minute. It's not a photographer. It's pornographer. Oh, okay. Now I see why. But Mia Khalifa, of course, decided to pump BlackBerry stock.
Is cracking down on the Robinhood thread. So I will be your new Robinhood thread. We are buying BlackBerry. Bye.
And right after she pumped it, that was the exact top in the stock, and we never looked back. And of course, Mia Khalifa is now pumping Dogecoin, aka Doggy Coin. And we know for a fact that Mia Khalifa knows her doggy positions very well. So I'm not disputing her investment advice. However, rumor has it that her stock picks have massive gaps in them. So if you're going to follow Mia Khalifa's investment choices, make sure that you use some form of protection. And by the way, she's not the only one pumping Dogecoin. Here is the king of dogs, Snoop Dogg. Dogecoin rises more than 36% after Snoop Dogg becomes Snoop Doge. So he changed his name from Snoop Dogg to Snoop Doge, and the crypto, and I say that sarcastically, it's not even really a crypto, risen over 36%. And we covered that Gene Simmons is now pumping Dogecoin in addition to Ja Rule and many other rappers and celebrities. What about the sentiment? Where do this new zombie generation of investors get their information from? Who has the most influence in the current market? TikTokers. Remember this crypto witch that we covered a few weeks ago? Well, she has another prediction.
The transits to GameStop's IPO chart right now are actually pretty insane, and actually a really good example of what to look for when a stock price rises. Ignore the houses, we don't have a time for the IPO, but it is approaching its nodal return, which is an emphasis on the north node, already an indicator of increase. But the major things going on are with Venus and Jupiter. Venus in the sky right now is approaching Pluto, an indicator of virality or growth. So with those two really close to GameStop's own Mercury, and Mercury often being something in the news or something, media-based, it's just funny that that would be indicating, Wall Street bets. Also, Jupiter and a lot of other things in Aquarius right now are highlighting Aquarius planets in GameStop's own chart.
Oh, and by the way, we will stop doing technical analysis in this channel from this point on, because I have found out for you than you, an upcoming technical analyst, and she is way, way better than me or any other technical analyst. So from now on, we will discontinue our technical analysis service and we will just follow this cleavage lady.
Hi guys, this is my first stock video full of tips. The market is going crazy right now and it's a good chance to make money. I'm going to talk about Apple. Everyone knows Apple, most valuable company in the whole world. For the last 6 months, we've seen it go sideways, and on Friday, it ran to all new highs. So my target price is 210. If it goes under 130, I would sell. Definitely about 50% potential on your investment over the next 3 to 6 months. Here's what the chart looks like. Hey guys, here's the chart. Ticker symbol is AAPL. If it goes above the blue line, buy. Below the blue line, sell. Hope you guys have a great week and make some money.
And here is more on how hysterical market sentiment has become.
Morale is low, and people are freaking out about how they're losing money because AMC and GameStop and all those other stocks are going down. So I just want to provide one insight that'll change your mind. In what world do stocks go down when people are buying them more and more? Right now, stocks like AMC, BlackBerry, and GameStop are being traded at higher volumes than they ever have been. Millions of people are buying them, more than they ever bought before. In what world would it go down?
Does anybody else think it's weird that you could take advantage of the fact that Robinhood gives you a free share of a stock just for signing up? See, the weird thing is, You'll sign up, you'll get your free share. Here's what I got, SiriusXM. But you could also get something like Google or Apple. It's a couple $100 for a share of a stock. But then the weird thing is, you'll say, maybe I could buy other stocks now. But wait a minute, I can't buy the stocks I want, like GameStop or AMC. So maybe I should just cash out this free stock that they gave me at a cost to them and go elsewhere.
This is the garbage, the jungle that we're living in. And here's my favorite. This guy is the best, absolutely the best. I might create a TikTok account just to follow this guy.
Man, 2021, what a start to the year. The little guy starts winning. Wall Street says we'll have none of that. Puts a hold on everything. You corrupt pieces of shit. I thought I was leaving Africa to escape the corruption. Turns out I was coming to the belly of the beast. You f***ers are just as bad, if not worse. And then what? You want me to go to school for 4 years? Spend hundreds of thousands of dollars? Get a degree so I can come over other little guys with you? Go yourself. The system is broken and it needs to be fixed. The solution that I'm seeing right now, crypto. Show me a better one.
Oh, and remember this Tiger King lady who was pumping a penny stock a few weeks ago? Well, now she's joining the ranks and she's pumping Dogecoin as well.
Hey, all you cool cats and kittens on the Dogecoin army. It's Carol Baskin from Big Cat Rescue. There is so much going on for Dogecoin right now. Oh my goodness. Check out all of the news and be sure and do all of your own research on this. And if you like what you see at Dogecoin, then donate to #Dogecoin to help animals if you can.
But rest assured, not all advice in the TikTok world is garbage. There is actually some solid advice floating around in that cesspool.
Here's the difference between investing in the stock market versus real estate. Here is how it feels to invest in the stock market. 1 hour you could be feeling good and then you're down. And then you're up and then you're down. I mean, this could be every minute or every second. Just like that. It's like you're laying at the hospital bed. They monitor your heartbeats and you don't know when the game will be over. Come on, man. Shit. Now here's real estate. With real estate, you start here and then it'll just slowly go up like that. This, you can have a peace of mind and actually go to sleep with. This, you don't know. Okay? So get rid of the get rich quick and focus on the get rich for sure.
And there you go, Jerome Powell. This is your functioning market. This is the environment that you have created. You must be very, very proud. Moving on to the whole holy war against shorts and hedge funds. And we know, of course, that hedge funds ended up being the biggest beneficiary from the donkey move from the retail traders who pumped GameStop and the likes. But while the media celebrates and continues to spread misinformation about this group, Wall Street Bets, painting them as heroes and as the common man rising against the machine and the establishment, when we know that this was an inside job orchestrated by Wall Street to use the donkey retail traders to become richer and then bury him alive. But this is about the hooligans who call themselves Wall Street Bets. They're not just young retail traders looking to defeat the establishment and looking for revenge to their parents who got robbed by Wall Street during the 2008 and 1990s crises. No. This is a cesspool of filth. And if you dived into Wall Street Bets forums, you know the kind of language they use, the homophobic remarks, and the kind of bullying and threats they're spreading all around the internet. Anybody who disagrees with them, they have to open their filthy mouth and vomit all over the place. But there is another side to their behavior, these hooligans. And of course, they're so bad, they make you have empathy for hedge funds and the criminals of Wall Street. This is how bad this group of hooligans is. Death threats and hate force hedge funds to step up security. We know that they threaten Andrew Left's children with death. And here is more. Gabe Plotkin, whose Melvin Capital Management lost billions shorting GameStop Corporation, hired extra security for his family after he was the target of anti-Semitic slurs and other insults, according to people familiar with the matter. Billionaire Steve Cohen said his family received personal threats promoting him to cancel his Twitter account. So we're talking about anti-Semitic slurs, and we're talking about this group of hooligans threatening Steve Cohen's wife. What does she has to do with all of this? If you have a beef with the man, talk to him directly. Don't threaten his wife. But this is of course the new generation of investors. They're just young kids, they keep telling us. But we know that within the Wall Street Bets Forum, there are hedge funds and there are retired Wall Streeters spreading a lot of misinformation to use these retail traders to get richer. But this is not a new phenomenon. Shorting has been going on since the inception of the stock market. It is another capitalist way to capitalize on companies that are already declining due to bad management, disruption, and fraudulent companies. And we've always seen negative and heated reactions when shorts announce or initiate their positions in certain companies and release the research, because some of these investors in these companies suffer losses immediately, when in fact they should trigger their anger and frustration toward the company itself for being fraudulent and for failing to deliver on results. Short sellers who asked not to be identified because they feared for their safety described previous death threats, attempts to hack their phones, people trying to enter their offices, and obscene messages sent to spouses. What a wonderful group these quote-unquote investors are. But sometimes it goes further. In 2019, the Financial Times reported how investors who bet against German payment firm Wirecard were under surveillance, including from a group led by a former Libyan intelligence chief. Matthew Errol, an early critic of Wirecard, said a suspicious car once followed his young son and nanny and took pictures of them, and that he was being watched from vehicles parked outside of his home. Once they even accosted him at his front door. It was a lurking constant threat, he said. It is very traumatic, and psychologically it is very difficult to deal with. This is what shorts have to deal with even when they expose fraud, such as when they did with Wirecard, because we have this hooligan kind of investing that is invading the market as of late. It's the most toxic environment in financial markets that I have ever seen. They're treating these stocks as tribes and sport teams, that anything negative that you say about the company or you even expose about the company, you become a target of their attacks. They're not investors. They're zombies high on meth looking for a score. And if you do the research exposing the fraud behind the underlying stocks they're investing in, all of a sudden you become a target for death threats. And now, of course, our government wants to wage war against shorts. You know who waged war against shorts? China. If you don't like shorting, you might want to move to China and enjoy the freedom and democracy of their financial markets. And of course, we have all of these billionaires who are egging on and leading retail traders to engage in this filth and risky behavior of trying to fight shorts who are exposing fraudulent companies and declining companies. They egg on these retail traders to take massive risk, but they're not taking the risk themselves. All done just to serve their egos, because somebody shorted their stocks at some point and they did not like it. But they have no regard whatsoever to the final outcome, to the retail traders they're egging on to lead this war. Here it is. Short sellers made $3.6 billion in profits so far this week on GameStop shares, after losing $12.5 billion in January. So now they're actually making money from the whole GameStop phenomena. What is the point? Sticking it to the hedge funds? Well, the hedge funds are winning from the whole scam. And here are comments directed at Elon Musk. I have become broke thanks to GME and AMC. Any help appreciated by those who are profitable. And of course, they're putting links to their PayPal accounts. They now became beggars. At first, they told us, oh, it's not about the money, it's about the message. All of a sudden, now they're begging and crying online. And they're even begging Elon Musk to conduct fraud for them. Remember, they accuse the shorts of doing fraud and shorting more than the float, but they have no problem manipulating the market when it happens to their side. They're no different than Wall Street. These people are not investors or traders. They're a bunch of hooligans. And the latest saga of this episode happens to be with another cult leader, Chamath Palate Potato Tequila. And of course, he is the king of SPACs. SPACs are empty shell companies that serve absolutely no purpose whatsoever, but selling hopes and dreams that at some point they will merge with another company and take them to the public market. SPAC managers win either way. They continue to collect fees, and when the IPO happens, they reap in massive profits regardless of whether retail traders who buy shares in that particular company is going to end up winning or losing when it's all said and done. It is the biggest scam in the markets right now. And we got the report from Hindenburg Research, a short seller, exposing one of the companies that used Chamath, Palate Potato Tequila, SPACs to enter the market. And in the report, they accused Chamath of violating his fiduciary duty and his due diligence by failing to disclose that this company is under the Department of Justice investigation, saying that piece of information was not critical to disclose. Clover Health and Chamath acknowledged that they knew about the Department of Justice investigation ahead of time, and they did not tell retail investors about the fact when they took the company public.
Welcome back to Squawk Box. We've got an update now on a story that we told you about yesterday. Shares of Clover Health falling after Hindenburg Research published a critical report on the seller of Medicare-backed insurance plans, calling it a, quote, broken business. Investor Chamath Palihapitiya holds a 27% stake in Clover and brought it public through a SPAC. In a response issued just moments ago, Clover saying that Hindenburg's report is, quote, rife with ad hominem attacks, sweeping inaccuracies, and gross mischaracterizations. It's also now saying that Hindenburg did not contact Clover prior to publishing that report. But importantly, Clover said this morning that it did receive a notice of an SEC investigation and says it intends to fully cooperate. And perhaps more importantly, it acknowledges that Hindenburg's research saying that there is a Department of Justice inquiry taking place and that they're cooperating with that inquiry was in fact true, and something that they did not disclose. They said they did not disclose it at the behest of their lawyers, who said that it would not necessarily be required to be disclosed, arguing that it was not material, but that in fact Chamath Palihapitiya and other investors and people involved in this transaction clearly knew about it as part of the diligence process in advance. Of course, the public did not know about that in advance. They're now saying they didn't have to tell the public about it in advance, saying that there are lots of inquiries in the Medicare space like this, and that this was, quote unquote, I don't know if they used the word routine, but that was the idea that they were trying to get across. But this is going to raise all sorts of questions about this particular transaction, but again goes to the bigger question around diligence in the context of an IPO, or rather a SPAC versus an IPO, and what's required in terms of disclosure. Right.
Andrew, what do you think on that? Because, I mean, it seems to me like that is an obvious. If there's a Department of Justice investigation and, oh, by the way, Medicare, a government payer, is your biggest source of income, almost your primary and only source of income, that seems like it would certainly be something, if it was an IPO, you'd have to disclose. You think that SPACs are that much looser? I mean, I know it's a little bit of a gray area, but I can't believe that would be something you didn't have to disclose.
Maybe it's the same. They're saying here that that their underwriters understood it, that the lawyers understood it, and that they deemed that it was not, quote unquote, material to disclose.
Smells crappy.
It is true that there are times.
Smells crappy. In this day and age, smells crappy with everything going on, and you know, the poor retail people that might have been, you know, involved in buying the SPAC that they didn't need to know, Andrew. I mean, and Chamath, Mr. Retail.
That's what.
Mr. Retail proponent, I'm a billionaire, but I love you and I'm one of you. It just reeks.
Now, you would expect that the retail traders in Clover Health will be pissed off at Chamath for failing to report the facts and tell them the truth about the company. Even if it is not a fraudulent company, an investigation via the Department of Justice is an important fact for me to know before investing in a company. But we are in the hooligan market. These are not investors. They're zombies hiding meth. They're hooligans looking for destruction and quick buck. They swarm in a group trying to pump stocks higher and make a quick buck. And in the process, they slaughter each other. There are no principles, no guidelines, no decency whatsoever with this group, even among one another. And here's a tweet I released on Friday. According to the new generation of quote-unquote investors, and once again, we're not talking about Gen Zers, millennials, etc. We're talking about the new zombie generation that invaded the market during the pandemic. If someone scams you by selling you a used car, only to find out later that the head gasket is blown, you're supposed to get mad at the mechanic who diagnosed the problem, not the scammer who sold you the car. Furthermore, if Theranos was trading today, it'll be trading at all-time highs. The new donkey generation of investors would be attacking short sellers or exposing the fraud. They will probably call them sexist and they're attacking a company because a woman is leading it, etc., etc. Even though we know the company is a fraud. But as the Dean of Valuation said in the previous video I covered, some people will need to learn via the hard way, pain. And you bet that this fraud, the SPAC fraud from Chamath Palate Potato Tequila, will be exposed at some point, and all of these retail traders, once they lose money and they realize that the majority of these companies are fraudulent, they will turn against the cult leader Chamath. And of course, Chamath responded to the allegations by Hindenburg Research, but it was a bullshit response, and here it is. Chamath, these accusations have no legs. And of course, they're making fun of Chamath because he released a shirtless picture of himself where he looked good above the waistline but looked terrible below the waistline. And of course, they're referring to his chicken legs. And while I dislike the man, I have to be fair. This is an unfair attack because it is clear that his right leg looks fine. It looks like a normal leg. The left leg is distorted and looks like a chicken leg. So either Chamath forgot to Photoshop his left leg, or, and this is the perhaps most reasonable explanation, there is a distortion from the camera. And by the way, Chamath, why are you using the old iPhone? What, are you poor? You need some money to buy the new one? Give me your PayPal account, I'll send you some cash. Get the new one with the electric shaver look, the 3 cameras, because those will make you look better. Of course, chicks on Instagram are using that camera because it makes their booties a little larger. So Chamath, you might want to upgrade your iPhone and make your chicken legs look a little bigger. And by the way, before we conclude this segment, let's finish with this. Remember this company, Lunking Coffee. When shorts exposed this company for the fraud it is, retail traders who are invested in the company got mad. But as the facts started to emerge, they challenged their anger and frustration toward the company itself, the company that defrauded them. And this is how it should be dealt with. Not taking your anger against the person who exposed the fraud, but against the company who is committing the fraud. Lunkin Coffee files for bankruptcy in the US, will keep shops open. And here is the take. The move is designed to protect the company from lawsuits by US creditors, including bondholders owed $460 million and shareholders. Lunkin Coffee's shops in China will remain open, and operations won't be affected by the filing, according to a statement issued on Friday. So if indeed Clover Health or whatever company we're talking about is exposed indeed to be a fraud and they have to resort to filing for bankruptcy, all of you quote-unquote investors who are challenging your anger against the shorts who are exposing the fraud and buying more shares of Clover Health, if the company files for bankruptcy, you will not get your money back. Period. Full stop. Moving on to the heat map analysis, starting with the heat map from Friday. And let's see what happened. Right away, throughout the week, you saw massive gains for technology, specifically big tech. On Thursday and Friday, we saw the inflow shifting where? To the laggards, the IWM names, the reopening names, and you saw hotels, casinos, cruises, airlines, all doing tremendously well. Likewise, we saw a decline in the US dollar, and that helped basic materials, gold miners, copper names such as Freeport-McMoRan, to surge higher. In addition to energy names, we saw massive gains for ExxonMobil on Friday. We also saw names reacting to their earnings results. For example, Activision Blizzard was up over 9% after reporting earnings. Meanwhile, T-Mobile down 4% or so after reporting their earnings. And by the way, if we see continuous declines in T-Mobile, that would be an opportunity to buy because the business is reporting excellent numbers. The price is just too high right now. And we also saw Zoom scoring massive gains, over 7.5%. That is due to the call options trade we covered during the options market coverage. Somebody's seeing something here. We don't know what it is yet, but they're betting that Zoom is going to explode higher this upcoming week. Let's contrast that with the picture for the entire week. It's a sea of green across the board. very, very few exceptions. The exceptions came from companies that reported earnings, and the earnings did not live to expectations. We're talking about Qualcomm, we're talking about Unilever, we're talking about British Petroleum, and some of the healthcare names. The healthcare sector in general lagged the overall market, specifically when we're talking about what? Drug manufacturers. The only exception here is AbbVie. AbbVie closing the week over 6% is a name that I own in my portfolio, one of my favorite names in the value stock segment of the market right now. So perhaps we will see inflow toward the healthcare sector next week because they're playing this yo-yo game. They pump one sector until it becomes bloated, and then they rotate to lagging sectors back and forth, playing this yo-yo game. So the question is, will semiconductor names that lag the overall technology sector and healthcare names catch a bid next week? We'll monitor that very carefully. Moving on to the ETF heat map for the week. It's an opposite picture to the prior week. A sea of green across the board, and the pain is concentrated in inverse indices. In addition to the XRT. Why the XRT? Because the XRT is heavily concentrated in GameStop and other names that are involved in the current battle between Reddit and the hedge funds. And I was going to discuss part of my strategy during the conclusion of the video, but we might do it here since we're already in the ETF heat map. I told you before the week started, I bought calls in the SQQs and puts in the XRT. Why did I do that? Because it is a battle between the Reddit names and the hedge fund names. If we see inflow back to the Qs and names like GameStop declining significantly, the XRT will get hurt and my puts in the XRT will appreciate significantly. On the other hand, if we continue to see the short covering activities going on in GameStop, the XRT will rally higher. Meanwhile, the short triple Qs will also rally higher, so my calls will appreciate in the SQQs while my puts in the XRT will decline. My strategy was to play both sides. This week, we saw names like GameStop declining significantly, and you saw the XRT going down. So my put options in the XRT appreciated while my calls in the SQQQ decline in value. So what am I doing right now? I took my profits from the XRT puts to raise cash and to average down in my SQQQ calls. Why am I doing that? Now that Robinhood lifted the restrictions in GameStop stock, I expect to see somewhat of a short covering rally to go on in the embattled names, meaning that the XRT perhaps is going to appreciate this upcoming week while we will see declines in the Qs, and I'm playing that particular move in the market. Moving on to the charts analysis, let's see what's going on here. Starting with the 15 minutes chart of the SPY. Once again, we gapped higher on Friday and we did not close the gap. So we have two gaps unfilled right now, illustrated for you on the charts. We will go down and cover those gaps perhaps this upcoming week, depending if we see weakness in the indices due to a short covering rally in the Reddit names, or if we see a panic situation, a panic event due to a surge in the 10-year Treasury yield. But what about the big picture? When we shift to a daily chart of the continuous contract of the SPY, we are trading at all-time highs. We're trading above the resistance level of 3,862. We're creating green impressions in the MACD indicator, and we have beaten the descending line in the RSI. Every single indicator here is bullish on the SPY. So looking at this chart, there is nothing bearish to see for now, until and unless we see a reversal signal. What would that be? A gap and crap kind of day, an engulfing candle, a reverse hammer, etc. Absent of that, the SPY, in the grand scheme of things, remains bullish from a technical perspective alone. What about the Qs? Similar story here, gapping higher, but the Qs traded flat, very muted activities, very low volume on Friday. The majority of the flows went into the IWM instead. What about the big picture for the Qs? And here is the bullish scenario. We talked about a blow-off top, and a lot of you asked me the question, what is a blow-off top? What does it look like? Go back to August of last year. We were battling the resistance level of 12,027 for a little while, a couple of days. And once we have broken above that level, it was a massive rally, an impulsive rally, and I called it at the time the last hurrah for the bull leg. And we called the reversal, for my older viewers who remember, we called the reversal to the penny. Are we about to see the same thing happening after beating the resistance level of 13,599? Certainly that is possible. And it is the bullish scenario. It means that the Qs will rally impulsively, but that would mark the end of the bull leg. And we will reverse and decline significantly after we're done with the blow off top move. What about the bearish scenario? The bearish scenario remains the same. We are still battling the resistance level and we are seeing somewhat of a double top formation. And if we reverse, we will go all the way back to the purple trend line, and that would be a decline of about 5.5%. What about the IWM? Gapping higher, attempting to close the gap, yet failing to do so, and now we have two gaps that we have left open during the week. Those will be closed in time. When? That is anybody's guess. For now, the rally goes higher in the IWM, specifically in the reopening names. We caught support from where? The upper limit trend line of the channel. These lines are not drawn randomly on the chart, are drawn to serve a purpose, and you see that the charts and the algos are respecting the lines I have drawn for you. What about the daily picture here? We're back trading at all-time highs. The declines from the prior week were merely a dip to buy. We've recaptured the channel and we are now trading above it. We've also made massive repair in the weakness of momentum in the RSI, recapturing the trend line once again and creating green impression in the histogram. However, the bearish scenario will happen if we see loss of momentum once again in the RSI. If you see the level of the RSI reaching, say, 74 and then reversing lower, cracking that trend line once again, that would be it, a confirmation that we have lost momentum in the RSI regardless of the autopilot flows that we witnessed this week into the ETF. So we continue to watch the momentum in the IWM. That is the most important thing to keep your eyes on when we talk about small caps. What about the Dixie? I told you that the ABC pattern is pretty much done. We could reverse any day now. The resistance level remains the 92. At least this is the most significant one. But we don't have to go there all the way. We could reverse from this point, 91.5. That would be good enough, and the ABC leg is finished. But don't make any assumptions yet. The momentum remains on the side of the US dollar, and trading next week will be very sensitive to the outflow of news regarding the stimulus from the Joe Biden administration. A larger stimulus will push the dollar lower. A smaller than expected stimulus will resume the rally in the US dollar. And of course, these statements from politicians will impact the movement in the US dollar this upcoming week. What about gold? We saw the bear flag playing, we had the death cross, we pierced below 1800 briefly, and then we climbed back when we saw declines in the US dollar on Friday. Be careful here of making any assumptions one way or the other. We're not going to see any clarity until we have a definitive answer regarding how big the stimulus bill is going to be. And of course, a trader asked me on Twitter, can you comment on the GDX? This is the miners ETF, specifically for gold miners. And he's seeing some weakness on the charts and asked for my opinion. From a weekly perspective, we're seeing significant weakness. A loss of momentum in the RSI, a loss of momentum in the MACD, but the damage has already been done. And we have reached significant support at the 33.5 level, closing the gap on the weekly chart. So perhaps you're a little too late to the move here. Furthermore, when we go to the monthly chart of the GDX, what do we see? We see a bull flag formation. That doesn't mean that the GDX cannot decline further, but the bull flag formation remains intact. So be careful making a long-term bet against the GDX here. And here is the take. Forget about the technicals. What's going to move the prices of gold will be, number one, the movement in the US dollar, and that is dependent on the news flow regarding the stimulus. Number two, the movement in the 10-year Treasury yield. If we continue to move higher in yields, that would be good for gold because inflation rises higher. However, if we decline, we see declines in the 10-year yield, say because the stimulus is less than we expect, you will see gold going lower, while the dollar surging higher. So once again, the technicals is just one aspect of the story, but the main driver for the GDX and for gold for that matter is the stimulus news. Moving on to the TNX, the 10 years treasury yield. We went lower initially when we heard the bad jobs report number. We bounced higher, all in all closing in the green. Look, when you have a bad jobs report and yields manage to climb higher, it means that the driving forces, the tailwinds pushing yields higher, remain intact. The rise of inflation and the larger stimulus bill. We have this cross look, some call it a doji, indicating indecision. So we're about to have a massive move here in the TNX, one way or the other. If it happens to be to the upside, say significant surge throughout the week, and we reach 1.25 percentage point, that could panic the market. In the grand scheme of things, 1.25 percentage point on yields is insignificant regarding cutting down stock market valuations, but it is the velocity of the move that is important. Because if we surge higher within a week to 125, that is an indicator that perhaps by the end of the year, we'll be already at 2%. By the time we're already trading at 2% in the 10-year treasury yield, the damage would have been already done. The stock market would have already crashed. So pay attention to the 10-year treasury yield, the most important chart to watch this upcoming week. And by the way, let's review the case from 2018. Remember the massive collapse that we had all of a sudden after the blow-off tax rally, the tax cuts rally in January 2018? Here's what happened. The SPY in orange, the TNX in blue. The SPY collapsed over 10.5% in a matter of days. Meanwhile, yields risen higher to the tune of 10% or so in the same time period. As the rally went impulsively and we heard about the tax cuts, inflation expectations started to pick up higher, and the 10-year treasury yield risen higher in a very volatile way. The velocity of the move itself caused a panic in the broader market. We could see the same scenario taking place this week or within a couple of weeks, depending on how high and how fast the TNX is going or rally. What about the VIX? Complete collapse here, a massive move to the downside. And the question is, are we done with volatility? Is this a signal that we're about to see that blow-off top rally? Or are yields going to rise higher impulsively very fast next week and beyond? And all of what we're seeing in the VIX here is stretching the rubber band to create another massive move higher. We cannot have a definitive conclusion looking at this chart. So let's move on to the VXX. I'm watching for a retest of the descending line that was resistance, became support, and now once again resistance. We are still hugging the trend line. We have not made a definitive move one way or the other. We certainly did not see the bounce we were expecting, and we went a little lower under the trend line, but it is not a definitive crossing yet. We will have a confirmation on Monday. If you see the VIX surging higher, then the retest and rebound is valid, and you will probably see the rubber band scenario in the VIX taking place. If we continue to dive lower, then we're getting closer and closer to the blow-off top scenario in the Qs, the SPY, the IWM, the broader market. What about Apple? I'm sorry, I don't have any update for you regarding Apple. The move remains stagnant, and it is a continuation to the discussion we had during the last video. It's a bear flag for now, until and unless we close above the 138 level from a weekly perspective. If we do that, then we have a confirmation that this is yet another move in the series of higher lows, meaning that Apple will continue to march higher to all-time highs. Failing to recapture the 138 line and closing above it will mean the bear flag will take place and we will break the upward trend in Apple. And when we do that, that would be the death sentence for the Nasdaq. As Apple goes, so will the Nasdaq. Apple is the leading indicator here. And what about Tesla? Tesla will be one of the most important charts to watch this upcoming week. We're still expecting the chart to go down and retest the yellow trend line, which happens to be the upper limit of the trading range. We have massive volatility in options, calls, and puts. Something is brewing in Tesla right here. And this stock we know since the rally started in March 2020. This stock moves solely based on the options activities. We saw more call options volume, but the dollar amount spent on puts exceeded the dollar amount spent on calls on Friday, meaning that the bulk of spending happened bidding on a downside for Tesla. We will see if these traders are right, or are we going to have positive news for Tesla instead. One way or the other, a massive move is coming for this name. And let's move on and conclude this video. What do we have in the earnings calendar this upcoming week? On Monday, we have Take-Two. On Tuesday, we have Martin Marietta. And we're watching this name because it is one of my Biden's top stocks. We're waiting for an entry point here, and perhaps if the company reports good earnings, yet the stock reacts negatively, perhaps that would be a good entry point for the name. Then we have Honda. We heard from General Motors, Ford, Tesla, all the other manufacturers about the new products, specifically in the EV endeavor. Honda remains lagging here. They're not talking about their next EV endeavors. Are we going to hear from them finally about the new EV projects? And will that excite shares of Honda to trade higher? Then we have Twitter, Cisco, and Lyft. On Wednesday, we have Toyota. They were supposed to report last week, but now we have a confirmation that they will report this week instead. We do have Coca-Cola. I own the name. I'll be watching carefully here if we have an outlook for a recovery this year or not. And we have General Motors. We know from the delivery numbers that we covered a few weeks ago that they have an uptick in deliveries, meaning that we're expecting positive earnings. However, the stock has already rallied impulsively. So what to watch here is the stock's reaction. And then we have MGM Grand and Uber. On Thursday, we will hear from PepsiCo, Disney, and Expedia. Anyways, that's all I got for you for this video, and I'm off to watch the big game. Enjoy your Sunday, and I'll talk to you again very soon. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.